Hello, this is Andy Pedraza with Special Effects Academy. Thanks for joining us for this reasonably short video. We're going to cover a very interesting topic, and that's discipline in trading. How you get into those trades tactically, and more particularly using a trading system. So with that said, let's start this show on the road. You're going to find three layers in everything that we do, and they're going to be a mission, the strategic, and the tactical components. Every human endeavor, like I said, shares these three layers. Your mission, and as a trader, you only have one, and that is to be a successful trader. Your mission is going to be that overwhelming purpose that you have, and if your mission as a trader is not to be successful, then you're in the wrong business. So the mission is very straightforward, very easy to understand. The strategic, that's the high level framework that is going to be supporting your mission. Everything in the strategy, and there's only one strategy that you can have that doesn't support your mission, just doesn't belong here. So your strategy is always going to be in support of your mission. And last, you have the tactical layer. And these are all the lower level activities that are supporting one or more components in your strategy. So they also support each other in turn to make sure that the mission is accomplished. Any tactic that is not furthering something strategic also needs to be eliminated. Now, we did a survey recently in our website, specialeffectsacademy.com, and we asked traders, one of the questions was what their main struggle was. Overwhelmingly, we found that the answer was finding trade entries. It looks like a lot of traders out there have the knowledge of technical analysis, fundamentals, this, that, and the other. They pretty much know what they're doing from a theoretical point of view. But when it comes to actually entering a trade, they either get analysis paralysis or they're very hesitant to actually click on that button for whatever reason. But that's because they're overthinking it. They really don't have a system. They're lacking the tactical. They may have that mission. They want to be successful traders. They may even have the high level strategy that they're going to be applying to get there, but they're lacking in the tactical. They don't know exactly what they need to do at a detailed level to further the strategy and in turn for that strategy to further their mission. So that's going to be the purpose here. And discipline is the main component that's going to allow you to execute all your tacticals to make sure that everything else is falling in place. Now, before we start out, and we all know that trading carries risk and that you may lose your money and then this, that, and the other, the standard disclaimer, we're not financial advisors. We're trying to teach you how to trade safely and consistently, but ultimately you are responsible for your trading. That being said, I'd like you to start an account, and it doesn't have to be a huge account. In fact, it should be a small one, minimum $100, maximum $500. Why am I asking you to do this? Because you're going to find that when you are actually trading with real money, the market behaves differently because the broker just has different conditions. Now you're going to be exposed to your spread, your commissions, your swap, a bunch of other stuff that you safely ignore during your demo trading, but is going to rear its head here. But more importantly, you're going to find that the emotions are completely different. When you have skin in the game, when you have actual money on the line, even a small amount, it's going to make a huge difference. You're going to be trading micro lots. We don't want anybody trying out a new system and putting large amounts of money. So you're going to be trading one micro lot. That's the equivalent of $1,000 in currency. Thanks to leverage, where you're getting at least 1 to 50, perhaps 1 to 33 in some pairs, in order to trade that $1,000, you're going to need about $20 to $50 as margin in your account to open that trade. So if you have a $100 account, you're basically going to be limited to trading the $20 micro lot margin pairs. If you have the 500, you can pretty much trade any pair, and you can carry 2 or 3, maybe up to 5 simultaneous trades open. Your stop loss on any given trade should never place more than 2% of your total equity at risk. That means if I have a $500 account, I can risk a maximum of $10 on any one trade. Trading in micro lots at 10 cents a pip, that means that my maximum stop loss is going to be at a distance of 100 pips, which would be those $10 that we just mentioned. And at no point are you going to be risking more than 20% of your equity at any given time. So you can have multiple trades open, but in total, they cannot be risking more than 20%. 20% of 500 would be $100. So when you add up the risk based on your stop loss for all your open trades, no single one of them can exceed $10, and in total, they cannot exceed $100 at a time. So these are going to be your conditions. These are going to be keeping you safe. And again, it should be an amount of money that's not going to cripple you, not going to make you lose sleep overnight if something goes wrong with the trading, and things can go wrong. We're not going to sugarcoat this. All trading carries risk. So be aware that any money you place in market is money that can be lost. Now we're going to have very strict rules. We covered some of them already. You cannot risk more than $10 in one trade. You can't risk more than $100 altogether based on a $500 account. Obviously, you need to adjust that down if you have less than $500. The rules are meant to keep you safe. They're not meant to be your final rules. This is something only you can determine. But they're the rules that I want you following as you acquire discipline. We have to learn how to walk first, and then we can learn how to dance and pick our own unique style. So start at the beginning, do it carefully, make progress, and then you can start evolving your rules to something that makes more sense. So just to re-stress that, you're always going to be trading with a stop loss every single time. No trade can be opened without a stop loss. That stop loss cannot place more than 2% of your total equity at risk. For now, all our trades are going to be at the 1 microlot level, which means 10 cents a pip. You will always trade with a limit. That limit is where the trade is going to take you out at profit if it reaches that point. And it's going to be at the same distance as the stop loss. We're going to explain that a little bit in a clearer fashion as we go along, but what I'm saying here is that if your stop loss is 30 pips away, then your limit is going to be 30 pips as well. You're going to try to capture the same amount of pips that you are risking in any trade, meaning that your risk ratio is going to be 1-to-1. And lastly, we're going to allow each of these trades to run until they either hit their stop or their limit. We're not going to be pulling the plug at any time. Just let them run. Eventually, they will hit the stop or the limit, and you will be taken out. So, what are systems? A system is simply a mechanism, let's call it an algorithm, that is going to be finding entries for you to take trades. There are many ways to find entries in the markets. You're going to see these referred to on other websites and material as strategies, sometimes systems. I really dislike the word strategy, and from my introduction, you can pretty much guess why. A strategy is something very large that is in support of your mission. A trading system is not a strategy, even if you call it that. So strategy is always that larger thing, that looming construct framework that we're going to be using strictly to further our mission. For anybody who knows what strategy is, if you studied it, military folks, or in logistics and business, you'll know what I'm talking about. So anything underneath the strategy, such as a trading system, is going to be part of that tactical layer. So we're going to stick to the term system for simplicity and just so we don't misuse the word strategy. In this exercise, we're going to focus on one single and easy to follow system. What's that going to do? It's going to take all the guesswork out of trading. you're going to see the conditions met on the chart. And if those conditions are met and the trade does not violate your risk management, your equity management, then there's only one thing to do, and that is to set up the trade and click on that entry button. That takes all the guesswork out. It takes all the emotions out. It takes all the second guessing out. More importantly, it's going to foster discipline within you, which is a component of the strategic layer. Discipline is always part of your strategy. So the tactical, in this case, the system, is supporting the strategic, the discipline, which in turn is supporting your mission, which is to become a successful trader. So every time we get a valid entry signal based on the system, no exceptions, we're going to enter that trade. Once the trade is entered, there's only one of two things that can happen. At some point, you're going to be exited at a loss because it hit your stop, or you're going to be exited at profit because it hit your limit. Nothing else can possibly happen. You will never close out the trade, just let it run until it concludes on its own. And every single trade you take based on this system, you're going to record it in your journal. This is so you can review that later, make sure that you were following the rules, you didn't make any mistakes, that you took all the trades that you were supposed to, you didn't take any trades that you weren't supposed to take, and everything is, again, creating that discipline within you. What time frame are we going to use? We're going to use the 1 hour chart. So all our entry signals are going to be based on the 1 hour chart using Japanese candlesticks. For the first 2 weeks, which is going to be the length of this exercise approximately, it can be a little bit less, it can be a little bit more, but in 2 weeks, you should be able to open enough trades that you can prove to me and prove to yourself that you do have the discipline to follow these instructions, to follow a system, and get your trading done. We're going to be using nothing but Japanese candlesticks and trend lines to identify the entries. No indicators, no fundamentals, nothing but what the candles and the trend lines are going to be telling us. As a later exercise, a step 2 and a step 3, and I don't know how many steps we're going to have. This is just your initial discipline creation exercise. We will be adding complexity via additional rules that are going to serve to filter out some of those entry signals generated. So we will be using indicators. We may be paying attention to fundamentals, all that, but not in this initial stage. Right now, the candlesticks and the trend lines are going to be the only things that exist. And of course, you're going to have to pick some pairs that you're going to trade. You cannot be consistently watching 28, 30 pairs at the same time and hope to get this done. So I would recommend that you pick 2 or 3 pairs, preferably ones that are moving nicely, and you'll recognize this in the 1 hour chart when you see it, that they are trending and breaking trends and this and that. You will find that that is a good pair to trade. So pick 2 or 3 of them, stick to them, have a schedule, make sure you're scanning those charts at the time of day that you decided you were going to trade. And every time you see a valid signal, which we're going to get to very quickly, anytime you see a valid signal come up, you are going to take that trade. Now here it is. This is the system we're going to be using. So the first thing we're going to do is we're going to go into that 1 hour chart and we're going to identify and draw all the active trends, inner and outer. Next, we're going to find the current trend. What trend is price action currently following? Identify that one trend and any sub-trends that continue to be created as it retraces and returns to its original direction. So, and I'll show you in an exercise in a slide that's coming up in a little bit what I mean by that. And what you're going to do is trade every single break. Once you identify a trend line, the active one, if that trend line is broken, you're going to trade in the direction of the break. So if it broke down, it started going, it broke the trend line and continued going down, your stop loss is going to be 10 pips higher than the most recent high. And again, this will be shown clearly on the example that I have prepared for you guys in a slide that's coming up. If it broke a trend line on its way up, so now it had been going down, broke the trend line, is now heading up, then your stop is going to be 10 pips below the most recent low. That will determine what your risk is. If that position is 35 pips away, so the low is 25 pips away plus 10, 35, then you're risking 35 pips. What's your limit going to be? The same 35 pips in the opposite direction. And your risk is going to be contained by $3.50 because 35 pips are $3.50 and your potential profit is going to be the same $3.50. Lastly, you're not going to take any further trades on that pair until that trade that you just opened concludes. And of course, if your stop loss is going to violate your equity or risk management rules, then you're going to pass on that trade. Otherwise, it is mandatory that you simply take it. And what we're trying to do is take anywhere from 25 trades up within 2 weeks. So try to be trading actively so you do get that number in. That way you have a good journal, you have a good review of what you've been doing, and more importantly, again, you're proving to me and to yourself that you have the discipline to use the system, give it the chance to perform, document your results, and do your analysis, your assessment, and figure out if it's working for you or not. The exercise is going to involve following the rules to the letter. I just gave you the rules in a very lengthy explanation. They are summarized on this slide. And you're going to document every single trade so you can review it later. 35 or more valid trades need to be placed to conclude this stage. I said 25 before, that's the bare minimum. Optimum 35. You can go as high as, whatever it is. It could be 100 trades, so long as you're following the rules. They were valid trades and they're within that 2 weeks period. Do as many as you possibly can. Just make sure you're not violating your equity rules or your risk rules, and everything else is fantastic. So here are the rules spelled out a little bit more clearly. Has the trend line broken? If yes, you're going to enter in the direction of the break. Your stop loss is going to be set above or below, depending on the direction of the most recent high or low of the trend that was just broken. You're going to check, now you know the distance in pips that the stop loss is giving you. You're going to check whether that stop would violate your equity or risk management rules. If it does, abort, no trade, pass. There will be another opportunity that complies with your rules. However, if it doesn't violate any of the rules, then you're going to set the limit to the same distance as the stop loss. If the stop loss ended up being 40 pips away, your limit is also going to be 40 pips away in the opposite direction. So your risk always 1-to-1. And once you place that trade, you will immediately record it in your journal. When the trade closes, because it hit your stop or your limit, you're going to record those results on that same line in the journal so you know exactly what happened. And we're going to call this first system the trend line break entry. And it is absolute simplicity. Again, no indicators, nothing other than the candles and the trend lines that you're going to draw. And here we come to an example. This is the GBP CAD. It is a current chart, so it's updated through today. And let's say that we started our system back here. Now, a lot of people have some confusion as to how to draw trend lines. There's nothing simpler, but you do have to follow that rule. And the rule is that a trend line is going to go from a low to a low if it's going up, or from a high to a high if it's going down. And these lows and highs need to be valid lows and valid highs. What is a valid low? A valid low is a candle whose extreme, its lowest point, is lower than its two neighboring candles on either side. So you can see this one is the lowest point of the 5 candles. 2 candles before the candle we're talking about and 2 candles after, this is the lowest point. The next low, which is where we drew the trend line, is also the 2 candles before and the 2 candles after are higher than the low of the candle we picked. So those are your rules. That's the trend line. On the other side of that, drawing a trend line from a high to a high, a valid high is the same thing, except we're talking highs and not lows. It must be the highest candle of the 5 candle set. 2 candles before it, 2 candles after it must be lower than that middle candle that we're going to be calling a valid high. And we find the next valid high and we connect the trend line. Your charting system is going to extend that trend line towards the right in all cases. I drew it from here to here and the system extended it into the infinite. I drew it from here to here and the system extended it infinitely in the other direction. Now, do you see where this trend line was broken? This first trend line was broken right here. That would have been my entry signal, and my stop loss would have been 10 pips above the most recent high. This one is the most recent high, 10 pips above that. My take profit is going to be the same distance in the other direction. And as you can see, if I went short here, this one would have taken me out at profit somewhere around this neighborhood. By that point, I will have been able to draw the next trend line, which is this one. And this trend line was broken here. So we can see the little blue arrow. This is where I would have gone long. My stop would have been 10 pips below that most recent low. And my limit, the same distance in the other direction. This one would have also hit the limit and taken us out at profit. Eventually, I'm going to get a new trend line. When that trend line is broken here, I will take that short. My stop loss, 10 pips above the most recent high. My take profit, the same distance in the other direction. Again, this one would have taken me out at profit. A new trend line gets drawn, and it is broken here. My stop loss, 10 pips below the most recent low of the trend line, and my take profit at the same distance in the other direction. Again, we would have been taken out at profit here. A new trend line is drawn. We go short. My stop loss, 10 pips above the most recent high, and my take profit would be the same distance in the other direction. Now, this one very likely did not hit the profit. So at some point, it just continued moving. Probably here it hit it. I stopped the exercise here simply because the trend line started getting too close and they may have started getting us confused. But if this limit did not get hit here, it never got near my stop, which was all the way up here. It just retraced a bit and then continued. On this lower candle here, it would have hit the limit. That is now probably would have hit it before that. So I did take a profit out of this trade, but it took a longer time to set up. I had a valid entry here on a trend line break, but guess what happened? I was still in this old trade, so I did not take this opportunity. I do continue drawing my trend lines. I get a short entry here. I cannot take it. I'm still in this old trade. And finally here, I am taken out at profit, and now I can go long again. When it breaks this trend line, I would again put my stop somewhere here, 10 pips below the low, and I would target somewhere around here. The only reason I didn't draw it here is because when I took that trade, this low had yet to be formed. So likely we're going to put it over here. This would be the valid entry, the valid stop, I'm sorry, for that trade. And actually the screen cuts it off. It is there, but the screen just doesn't show it. And of course, our limit is going to be somewhere up here, but that now brings us to the current price. So this is would be a still open trade, most likely still working to fulfill that, that limit. So there you have it. It's a very simple, again, just the candles and the trend lines. You get a trend line break, you enter in the direction of the break, stop loss 10 pips above, limit the same distance in the opposite direction, and then you just repeat that as many times as it gives you trend line breaks along the way. As you can see, all of the trades here were profitable. It's not always going to work that way. This exercise is not meant to make you tons of money. It's meant to instill discipline in you. Some of these trades will be losers. I picked this chart at random, and as luck would have it, it would have been a brilliant chart to work this strategy on. But you can't guarantee that's always going to happen. You're going to have some trades that break a trend line and then fail to hit the limit, eventually hit your stop. So you need to be prepared for that. It's not a cause for concern. About half your trades on a good week are going to be losers. The important thing is that you're not risking too much on the losers and you're gaining on the profitable trades. That will keep your account healthy. And as we add more rules, when we add complexity to this exercise, once I see that everybody has the discipline to follow these simple rules consistently, then we're going to see how we can maximize our profits and minimize our losses. But the sole purpose of this exercise, discipline. You need to have it. That's what's going to make the difference in your trading as you start out. So hopefully that was clear. If you have any questions, by all means, send them our way, either by email or by commenting on this video using our Facebook page. Just don't deviate from what I told you to do here. This is your first step towards trading with discipline, and in turn, a key step towards becoming an elite trader. And that's pretty much the end of this hopefully short video. I hope I didn't take too long. We're going to have our main contact info is going to be on our website, which is specialfxacademy.com. You will find there ways to email us, a link to our Facebook group, a link to our YouTube videos. Everything will be there at specialfxacademy.com. Don't hesitate to reach out if any of this wasn't clear. And of course, we'd love to see your results. So get back to us and let us know how you did in the 2-week exercise. And we will be releasing further videos as we go along with the next steps in the exercise. The intention is that you get this discipline and continue building on that. So that is going to be the end of this presentation. Again, any questions, please reach out to us and let us know that you've started. And of course, let us know your results. We're very eager to hear back from you. Thanks again. This is Andy Pedraza with Special Effects Academy, signing out for today.